Investing. It's a word that can seem scary, complicated, and only for the wealthy. But let me tell you, that's just plain wrong. Investing is for everyone, and it's easier than you think. Today, we're going to break down two popular investment options: index funds and mutual funds. Index funds and mutual funds are both ways to invest in a variety of stocks or bonds. Think of them like baskets full of different companies. Instead of putting all your eggs, or in this case money, in one basket, you spread your risk and increase your chances of growth. These funds are managed by professionals, which takes the guesswork out of picking individual stocks. They do the research and make decisions on what to buy and sell. This makes investing accessible even if you don't have a finance degree. Whether you're just starting out or have some investing experience, understanding these two options can put you on the path to financial freedom. So, let's dive in and explore the differences between index funds and mutual funds. Now let's talk about what sets index funds and mutual funds apart. The main difference lies in their investment strategies. Index funds are like autopilot for your money. They aim to track a specific market index, such as the S&P 500. This means the fund holds the same stocks as the index, and its performance mirrors the index's performance. It's a set it and forget it approach. Mutual funds, however, are managed more actively. A fund manager makes decisions about what stocks to buy and sell, aiming to outperform the market. While this sounds appealing, it often comes with higher fees and doesn't always guarantee better returns. Think of it this way: index funds are like cruising down the highway in cruise control, while mutual funds are like navigating a busy city with a driver. Both can get you to your destination, but the journey and the cost will be different. Understanding these key differences is crucial in determining which option aligns better with your investment goals and risk tolerance. We'll delve deeper into the pros and cons of each in the next section. When it comes to investing, fees matter. They eat into your returns and impact your overall profits. So let's break down the fee structures of index funds and mutual funds. Index funds are known for their low fees. Because they follow a passive investment strategy, there's less management involved, resulting in lower expense ratios. This means more of your money stays invested and working for you. Mutual funds, on the other hand, typically have higher fees due to the active management involved. Fund managers charge fees for their expertise and the research they conduct. While some mutual funds outperform the market, others fall short, and those high fees can still sting. Remember, every dollar you pay in fees is a dollar that's not growing your wealth. It's essential to carefully consider the fee structures of any investment before you commit. Feeling overwhelmed? Don't worry. Let's look at some popular index funds and mutual funds to get you started. In the world of index funds, the Vanguard S&P 500 ETF, VOO, is a popular choice. It tracks the S&P 500 index, providing broad exposure to the US stock market. Another option is the Schwab Total Stock Market Index Fund, SWTSX, which invests in a wider range of US stocks. On the mutual fund side, the Fidelity Contra Fund, FCNTX, is a well-known, actively managed fund. It invests in large-cap growth stocks, aiming to outperform the market. The American Funds Growth Fund of America, AGTHX, is another popular choice, focusing on long-term growth potential. Remember, these are just a few examples, and there are countless funds available. Do your research, compare fees, and choose investments that align with your financial goals.